check. If people online can't hear us, they'll tell us, right? Can you hear? Okay, good. Thank you. Okay. Welcome. Okay, so for those who don't know me, my name is Angie. I help run the new Ventures BC competition. I know a lot of you are in the competition right now, so thank you and good job completing your round 2. So as we wait for the results, it'll take a few weeks. It gets reviewed by I think it's over 100 judges in all of them, so it takes a while. But as we do that, there's lots of education to come. So today's session is on corporate structure. So we have 3 lawyers to tell you about this. So Geoff, Pedlow, Sampley, and Chris Ross. So
shall we pay them?
Pardon me?
Shall we pay them?
You can if you want to.
Because Fasken is a very long history. Long term.
True. Okay. Well, consider this legal education, not legal advice.
Yeah.
I think there's a disclaimer.
Thank you. Probably in here somewhere.
Yeah, there's a disclaimer, I'm sure. Yeah. And then I'll also say on Saturday, we're doing our startup sprint day 2. So I don't know if you went to day 1, you kind of notes all day, 9:30 till 4:30. And we crammed about 3 or 4 different topics in on that day. So this Saturday, it'll be capital raising, what else? HR, sales and marketing, and pitch. So you can come in for all of them, or you can come in for a few. So you're welcome to join. Otherwise, I'm going to thank the sponsors, and then I'll pass it over to Team Fasken here to take you through corporate structure. So our title sponsor is Innovate BC. Our gold sponsors are EY, SFUVB School, UBC Saturn School, National Bank, and of course, thank you. Silver sponsors are TELUS Ventures, Volition, and the Angel Network. And bronze include Web Names, VEF, AceTech, Angel Forum, Backstretch, HR Recruitment, and RBCX. Thank you to my sponsors. Thank you for coming. We have about 25, I think, online as well. So I'll monitor the questions online and ask as they show up. Otherwise, do you guys like questions?
Yeah, I was just thinking about actually probably best to save questions to the end. I find sometimes a question gets answered in like the next slide. So to the extent you can, and we can always back up at the end of it. Are we wrapping at 5:30? Is that okay? So we'll try to leave as much time as we can at the end for questions. I know there always are some.
Yeah.
But that'll be the plan.
Okay, perfect. All right. Well, thank you
Awesome.
again for everyone, and we'll pass it over to you.
Thank you, Angie. So we'll just do a quick intro of who we are and what we do, and then dive into it. We've got a lot of material to cover today. So my name's Geoff Pedlow. I'm a partner in our technology group. So I work part of a team of 25 lawyers that are in Vancouver that work exclusively with startups, high growth companies, entrepreneurs, and investors that invest in them. We're a team of about 80 lawyers across the country, but there's about 25 of us here locally.
Samly, I'm a partner in the securities group. My main practice would be working with public companies, raising money, or doing kind of M&A transactions, or general day-to-day continuous disclosure. But about 25 to about half of my practice maybe would be with private companies as well, typically M&A, but also some startup type financings.
And I'm Chris Ross. I'm a associate in the tax group here at Fasken. And I mainly do sort of transactional kind of M&A tax support work. So mainly supporting these guys in the work that they do.
Chris, and so we are a full service business law firm, and so we have subject matter experts in various different areas. We've got 155 lawyers in BC and offices across the country and in a few international jurisdictions. Because we have a lot of content today, I have some like self-promotional slides that I'll kind of skip through. Oops, skipped way too far. I think the slides are available afterwards as well. If you want to look over anything. So diving right in, just as a high level, what we're covering today is corporate structuring and then sort of legal agreements that are related to the relevant structuring steps that we'll talk about. So from a corporate structure perspective, how to set up the company, usually, which we'll talk more about. What does the equity ownership look like, your cap table? How do you attract team members and attracting and closing financing? On the legal agreement front, so document your sort of foundational documents among the company and its founders. Internal documents like a shareholders agreement, so sort of all the documents that ensure you have the right pieces of the puzzle and the right tools in the tool set. And then externally facing, where you're interacting with like customers or investors, we'll talk a little bit about those as well. So when it comes to actually setting up the company, there's a number of different ways that you can do it. I'll skip ahead a little bit and say almost every startup company or most companies are structured as or they're incorporated as a company, and that can be done either federally or provincially or in another jurisdiction. And we'll drill into that a little bit more, but just briefly what the other options entail. So you could be a sole proprietorship, which is effectively the most simple form of a business organization. That's basically yourself running a business potentially under a trade name, but it's sort of your personal operations. And often a startup would be a proprietorship until it incorporates the point that it's ready to sort of start commercializing. There's also partnerships that's multiple parties operating together with a view to a profit. It could be a joint venture, which could be just a contractual relationship. And then there's limited partnerships, which are usually used for like fund structuring. So that's just kind of an idea of what's available out there, but for the most part, what you need to know about are companies. The general structure of a company is outlined here. So there's the shareholders. It could be individuals. They could be, a company could be a shareholder of the entity. You've got directors, officers, employees, and an advisory panel. We'll drill into what each of these entail. Oh, sorry, this is over to you now.
Okay.
Yeah.
So yeah, I mean, I'm sure you've kind of seen the structure before. It's just a standard company. Shareholders at the top, one of them holding through a holdco. Then you got the directors. So the shareholders nominate the directors, and the directors get to name the officers. And the officers are kind of running the company day to day, presumably hiring employees, and then you might have some sort of external advisory panel. So, what is a shareholder? And really anyone can be a shareholder. That means it could be individuals, it could be other companies, it could be partnerships. They're generally understood to be kind of the owners of the company. They become shareholders by buying shares, and shares are essentially, a portion of the company that kind of has a bundle of rights that you purchase for cash, presumably, and then the company gets to take that cash and does whatever they do, build their widgets or whatever. So as part of these bundles of rights, the main concept of a company is that there's limited liability. So for shareholders, they can lose up to the amount of money that they put into the company and buy their shares with, but presumably they wouldn't, under very limited circumstances, can they lose more than that, as opposed to, potentially a partnership or a sole proprietorship. As mentioned, a shareholder buys a share, and the share gives them a certain bundle of rights. These rights, kind of are listed there as a variety of them. You can either have a common share or preferred share. You can have voting rights. Some shares have no voting rights. For example, you might want employees or kind of passive minority shareholders not to get voting rights. You can have rights to dividends. They can either be kind of a yearly, annual, cumulative dividend. It could be just, when you have excess cash. For startup companies, typically you're not looking to pay dividends early on. You want to keep that money in the company to keep investing it in growth. And then you have participating, non-participating. That's really talking about on the exit. Do they get a capped fixed amount of money, which would be non-participating, or do they get to just generally participate in whatever funds the company ends up with for assets? There's other potential rights there, preemptive rights, which means that, you get to kind of protect your percentage ownership of the company, anti-dilution rights, down round protection, all these kind of more unique and bespoke type rights. That really comes in based on, how well or how much power the investor can negotiate these additional rights. Angel investors, for example, will often ask for, a preference in liquidation. They'll ask for preemptive rights, down round protection, all this type of stuff. And then in terms of, number of shareholders, there's really no limit to the number of shareholders you can have. With the caveat that, the fewer shareholders, the easier it is to kind of deal with your day-to-day. If you ever need, shareholder approvals and things like that, the less shareholders, the less complicated it is. We will talk about kind of a 50-person threshold. There's a few things that kind of turn on that threshold, and that threshold is kind of just a general one, and that number is actually subject to a few other things that we probably won't get too far into, but and then one other thing is, before you start, rushing out there trying to sell a bunch of shares and bring in a bunch of shareholders, there are rules that we will talk about later on how you can raise funds through selling shares. Going back, I think. There we go. So we kind of already talked about this, but shareholders effectively, the way they own the business, run the business is by electing directors, and the directors are kind of shepherding the company at high level. There can be other, so that relationship's kind of governed by the articles of the company, but there can be other contracts that govern the rights of the shareholders, such as a shareholders agreement, or any sort of external third outside of the article agreement. The real difference is, if you have a share and you sell that share, whoever buys that share now has that bundle of rights, whereas a contractual right, it would kind of depend if you're assigning that contract or, that's more for the person signing the agreement. Directors.
So as Sam mentioned, the shareholders or the owners of the company determine who the directors are, and then the directors in turn are responsible for effectively managing the day-to-day business. They're elected by the shareholders. There's limited circumstances in which the directors can kind of add to the board themselves, but generally think of it as the directors are kind of serving at the as determined by the shareholders of the company. You have to have at least one. There isn't a limit to the number of directors that you can have, but practically speaking, it can get pretty unwieldy when you have a large board. So most companies will keep it small. Even very large companies will have a board of, say, no more than sort of 7 or 8 members. There's residency requirements in some cases. In BC, that's not the case. No longer the case in Alberta or Ontario either. That's recently changed. And then federally, if you're incorporated federally, you still need to have, I think, 25% of your directors must be Canadian resident. So that sometimes can determine where you're incorporated, depending on if your directors are resident here. And then there's qualifications, like you can't be bankrupt. There's sort of criminal convictions that preclude you from being a director, or you have to be, I think, 18, things like that. I've worked with founders before that are kind of still in high school and determined that they can't actually serve on the board of their own company. As I mentioned, so the directors are tasked with managing the day-to-day business of the company. So that can be scaled back in a shareholders agreement, or you can set restrictions on that. But generally, the shareholders aren't making the day-to-day decisions. The board makes those decisions, and then, as I'll speak to a bit later, they delegate that authority in some circumstances. The directors have duties, they have fiduciary duties to act in the best interest of the company and its shareholders. And so that's an important thing to keep in mind when sitting on a board, wearing the board the director hat is making sure you're thinking of and acting in the best interest of the company, and each time you decide to approve something. And that can create potentially personal liability in some circumstances, and there's also potential for personal liability as a director, where there's unpaid wages for employees, unpaid taxes to the government. And then, as I mentioned, the last part of this is the directors then, because they're not always in their capacity as a director actually operating the company, they delegate that authority to management, so elect officers who then can in turn hire other employees. The officers have sort of the authority that is delegated to them by the board. In most roles, there's sort of an assumed role and responsibility. Like if you're hired as the CEO, you kind of understand what that entails. Similarly, other sort of C-suite roles, but it can be customized as much as you'd like. You can have as many different officer titles as you want. You don't have to have officers. You don't have to use certain titles. You know, traditionally there was like a president and a secretary. You don't see that often anymore. Often there's sort of C-suite titles, but you can be any kind of creative officer title you want. And then in general, the officers are kind of the management of the company, actually operating the day-to-day under the authority of the directors. And then, as I mentioned, the direct officers then in turn elect sort of other employees of the company to carry on other more specific roles, which I'll hand back to Sam to talk about.
So employees, I mean, you probably all understand this relationship already, but you know, just to be clear, typically, you know, just because you call someone an employee or call someone a consultant, it'll really, if that's not usually determinative, it'll be kind of the relationship and how practically it works out. So, you know, employers, employees, they typically call it like a master servant relationship in a sense that you can direct and control, you know, where they work, how they work, timing and whatnot. Obviously there are, you know, full-time, part-time employment, there's fixed term employment and all that, but you know, generally speaking, an employer can direct how you do the job. Employees will have certain rights typically under the employment standards legislation, minimum wage, overtime, vacation, that type of thing. And also there will be statutory obligations for employers over employees for like deductions and things like that. And there also would be notice and severance type provisions. Those would be under the Employment Standard Act and potentially under common law. So obviously it's, yep.
Yeah, I mean, I guess this might help understand, you know, you could be the founder and so you're the shareholder, you might be a director, you might also be an officer. You're wearing a kind of a different hat in a different circumstance. I would say, you know, with your shareholder hat on, you decide who the directors are. And then the directors then kind of ultimately are the decision makers. And so as between the directors and the officers, the directors kind of have more authority because the officers only have the authority that's delegated to them by the board. So you just have to keep in mind which hat you have on in that particular context to decide sort of how that decision would be made.
I think we could talk about that later about, you know, kind of conflicts of interest and the different hats you guys will wear.
Yeah.
So going back to the employment, you know, I'm sure we've all worked jobs where there was an actual employment agreement. But we, you know, obviously we think it's smart to have one in place. It can set out things like vacation entitlement, severance entitlement, that could potentially limit the liability of the company. You know, if you ultimately fire someone or whatnot. You know, without a clause in your employment agreement, severance is determined by common law, and the common law entitlements can be quite high. For assignment of IP, you know, it's always good to just have, you know, express kind of provisions about assignment of IP. You know, although there are some implications or some standard assignment of IP provisions or assumptions. And then, you know, you often see like non-comps and non-solicits. Just keep in mind, non-competition provisions are quite hard to enforce. You know, courts don't like to limit the ability of people to work, essentially. Non-solicits can be more common, so, you know, you can't come and steal our customers that you've interacted with the company and whatnot. So those are more possible to enforce. Now, for what are the differences with consultants? Consultants have no. consultants aren't employees, they're not entitled to, you know, kind of the employment benefits. The real difference between a contractor and employee is that contractor, you kind of pay them to kind of do a job but it's really up to them how they do that job and how many hours they spend. As long as they get the job done, you're paying them for the job. You know, it can be hourly and it can be whatever, but in the end, you're paying them to do a job and it's up to them to kind of figure out how to do it. So they're not entitled to traditional employee benefits like, you know, vacation, you know, their vacation severance, that type of thing. And they're not protected under the employment standards legislation. Yeah, there would be, you know, there'd be no deductions and things like that. That's up to the contractor potentially to do. You know, as an example, contractors assume more of the risk on if the project ultimately gets canceled or whatever, you know, if there's provisions on how to cancel the consulting relationship, then you can just do that under the contract. That's up here. I mean, a lot of the difference will end up being stuff that Chris will talk about, which is on the tax end of things. So consulting agreement, you know, we have the same type of concepts here. In a consulting relationship, you do want to have, you know, there's more of a focus on getting the assignment of IP provisions. You know, because a consultant can potentially be working on multiple contracts. So you just want to make sure, hey, any IP you're working on here is ours, because they're their own thing. You know, they're not like an employee where they're clearly it doesn't automatically flow through the employee-employee relationship. Yeah, okay. And then, like we said, tax.
Just to reiterate a couple of things Sam said about, so when it comes to written agreements with employees and contractors, you know, often people will be employed on sort of verbal terms, but, you know, critically for employees, it's that severance obligation. So having the ability to sort of terminate with the minimum statutory requirements. Assignment of IP is important, but there's kind of a common law sort of deemed ownership of the employer. With consultants, the most important thing is the IP ownership, because it's kind of the opposite. Consultants generally own the IP and the work that they provide, so you need to specify that that's owned by the company. So in both cases, a written agreement is important for two different reasons. So just always keep in mind, try to get a written agreement every time.
Okay, so the tax implications of in particular compensation that are paid to the worker ultimately depends on sort of the substance of the relationship. So as Sam talked about earlier, is this person sort of in substance an employee versus a contractor? And so in the sort of the obvious case, or sorry, in certain cases, it's really obvious what's an employee, what's a contractor. So this sort of master servant type concept. It's sometimes very obvious, but it's also like one of the most litigated areas of tax. Like it's just a constant issue that's always coming up. And that's probably, at least in part, because there's just different tax treatment. And often there's at least a perception that maybe it's sometimes better to be a consultant than an employee. Usually that's because in general, a contractor is entitled to much more deductions basically in computing their income. Basically any expense incurred for the purpose of earning income is potentially deductible. There's limits, etc. But that's the general idea. Whereas an employee, the starting point is basically nothing is deductible unless there's a specific deduction allowed. So because of that, there is sometimes a tension between, okay, we would prefer to be a contractor for tax purposes, even though in substance you may sort of look a lot like an employee. And so ultimately the tax treatment depends on what you actually are at law. So the agreement itself is important in this analysis. So if it's called an employment agreement, that's important. It probably points towards being an employee, but it's not determinative. And so basically the CRA will look at just all sorts of factors to determine whether or not you're a contractor versus an employee. And really they boil down to control. So the more control that the company has over you, the more likely you are to be an employee. And on that note, so while there is a preference in a lot of cases to be a consultant for tax purposes, there's also certain benefits that are only available as an employee. And one of those is stock options, which I'll talk about. So turning to sort of compensation and incentives, there's sort of three main possibilities. So there's cash, obviously, that's fairly easily understood. There's shares. You can just straight issue shares, for example, to a worker, and then there's stock options. And again, these are sort of the main possibilities. There's dozens, maybe hundreds of variations within these, but these are sort of the main options. And in sort of the startup context, stock options are certainly the ones that we see most often, in part because they don't require cash, and also in part because they have good beneficial tax treatments. And so I'll focus on a little bit on stock options. I cut out a lot of the detail from a lot of my presentation, but I kept some of the detail of stock options because at least I think it's important, and it's very common, and I think it's just important to understand, first of all, just what they are and how they're taxed because of how common they are. So just before just to start, sort of what is a stock option? So basically, a stock option is just a contractual right to acquire a share of the company at a certain price. So, for example, if let's say the share of the company is worth $1 today, you might get granted an option to acquire a share for $1. That would be sort of a fair market value grant. And then there's all sorts of limitations and vest. So, for example, maybe you can exercise that right today, like immediately, and acquire the share. Maybe you have to wait a certain amount of time. Maybe it's subject to sort of vesting conditions. So maybe if they're time based, maybe you have to wait a year until you can exercise. Maybe you have to hit certain kind of performance type milestones. So they're really flexible, and they're good in the sense that they sort of align the incentives of the employee with the company. So there's an incentive on the company because they share effectively in the growth of the company by virtue of the value of shares. The idea is it sort of aligns the incentive of the employee and the company. So to appreciate the tax treatment, the tax benefits of stock options, as a starting point, in general, as an employee, basically anything you receive from an employer in general is fully taxable employment income immediately on receipt. So anything of value that you receive from the employer, as a general rule, is fully taxable. That's sort of the starting point. There's exceptions, but that's the starting point. Stock options are a key exception. So we'll start by talking about stock options for CCPC. So CCPC stands for Canadian Controlled Private Corporation. We'll talk about what that means a little bit later in the presentation, but for our purposes, most startups in sort of the domestic Canadian context are going to be CCPC. So it's a common type of company in this context. So as we look through the main stages of a life cycle of a stock option, on the grant of a stock option, this is when the company grants you a right to acquire the share at some date. There's no tax consequences. So already there's a difference from the general rule. There's no that you arguably receive something of value at that time, but there's no tax at that point. Then let's say the next sort of event is the option vests. So now you can actually exercise that right. So if there's an exercise price, you have to pay the exercise price, but you as the holder of that option have the ability to exercise them. Then when you exercise the right and actually acquire the share, the underlying share, also no tax consequences. And that's sort of the key benefit for stock options and stock options granted by CCPCs in particular. So I'll talk after about non-CCPCs, but the fact that there's no tax on the exercise is a significant tax benefit. Now you own the share, and then you sell the share. So that's when the next sort of tax event happens. So that's when tax is actually payable. And so the tax is based on, there's sort of two elements. One is you have an employment benefit equal to the value of the share at the time of exercise minus what you paid for it. So that is an employment benefit, and so as in fully taxable. But if certain conditions are met, you get a deduction of half of that amount. So the effect is you basically get taxed on it like a capital gain, as opposed to normal fully taxable employment income. And so the deferral, like i.e. no tax on exercise, and this half taxable notion are the key tax benefits for stock options. And again, one of the reasons why they're so often used. And then for non-CCPC, so public companies, for example, the main sort of tax difference is when you exercise the option and acquire the share, you have tax at that point. And so the tax at that point is based on the value of the underlying share when you exercise it, and the minus the amount you paid for it. So if when you exercise the share is worth $2 and you paid $1 for it, you have a $1 employment benefit. Again, if certain conditions are met, you can deduct half of that. So again, you can get capital gains treatment, but the conditions are different here. So one sort of the key in non-CCPC stock options is to get that deduction, the option has to be granted at fair market value. So if I grant a right today to acquire the share, the exercise price has to at least be equal to the value of the share today. And I should have said all of that applied to stock options for employees. Basically, there's a whole specific tax regime set out that deals with employees. And the opposite is true for consultants. There's basically no specific tax rules for them, no tax incentives. It's just sort of general principles. So, generally speaking, when you grant a stock option to a consultant for consultant services, for example, on the grant of the option, the consultants basically the value of the share at that time minus whatever exercise price there may be is basically fully taxable, just normal business income to the consultant at that time. And then subsequently, when they exercise that option and acquire the share, any increase in value from exercise to grant is either also fully taxable business income or capital gain, just depending on the circumstances. So next we'll talk just briefly about so-called cross-border employees, just because this is sort of increasingly relevant in this day and age with remote work, and just more and more you're having a company with an employee that wants to work elsewhere and sometimes in a different jurisdiction. So I think the main point here is it can create tax issues for both the employer and the employee. And so I think the most important thing is if you are a company and you hire someone and they want to work remotely, let's say from a different country, you should ideally get tax advice beforehand. There's a couple of risks that can be created for the company. So in particular, if a company is based in BC, everyone's in BC except certain employees in the US, for example, the concern is, by virtue of having employees working in a different country, are you now exposed to that country's tax system? So maybe you've created sort of a tax nexus with that country. Maybe you have to file a tax return. Maybe you actually have to pay foreign tax in that jurisdiction. Maybe you have to withhold foreign tax on account of that employee's income. All sorts of things. And similarly, but a bit less pronounced, is if you have an employee working in a different province. So kind of similar ideas. Now you're sort of within a different tax jurisdiction potentially. I say less pronounced in a different country because it's still all within Canada. So okay, you have to allocate your tax between two different provinces. Maybe it's not as big a deal as with a different country. So I'll pass it over.
Yeah, thanks, Chris. So this sort of last group of sort of participants in the corporate structure that we're talking about, called an advisory panel here. It's, it could be an advisory board. That's probably the most common name for it, or advisory council. It's not really sort of a discrete category. These are effectively consultants. They're contractors. And mentioning them here because typically they're compensated with stock options. You don't often pay these individuals sort of any cash compensation. They're advisors that are available to the management or the board with particular subject matter expertise. It's kind of an ad hoc relationship, and typically, and it's somewhat unique as well to the sort of startup ecosystem. Most other maybe traditional businesses may not have contracted advisors of this sort. So Commonly you'll encounter this, and generally they're compensated with stock options, as I mentioned. So now you understand how those work from Chris. And it would be taxed accordingly. So you just need to be mindful of that when you're granting stock options to advisors. Else, and just keep in mind too, just for vesting schedule purposes, often advisors are sort of, they vest their stock options a little differently than employees would, just because that's the only way that they're compensated. Usually they're a little bit more generous about it.
So I mean, we kind of talked about it before, but just keep in mind, there's always going to be conflicts of interest within your structure. You know, just you yourself could end up being a shareholder, a director, and an officer. So, you know, just keep that in mind that the one thing that's important as a director or officer is that you have fiduciary duties. You know, you have to act in the best interest of the company. Even though you're also a shareholder, you can't, you know, be acting with your shareholder hat on. You always have to act in the best interest of the company. So just within your structure, you know, you could be a shareholder and a director. Your directors could be directors of multiple companies. You'll see that quite often. You know, there can be conflicts between the company and any sort of educational institution that you are contracting with for pricing or whatnot. And also between your various investors, they'll all have their own individual wants and needs, right? So, you know, how you deal with that, you know, it is part of the difficulty in having multiple shareholders, and you can have shareholders agreements to kind of dictate that up front. But, you know, you just keep in mind that the more shareholders you have, the more different interests you have to keep in mind. So just at a really high level structuring, you know, first thing to think of is where you're going to incorporate your company. And you often hear like setting up in Delaware is great and all that. I mean, we like to think that BC has a pretty friendly jurisdiction for corporate law. You know, if you plan on raising money in Canada, having Canadian employees and all that, we think incorporating in Canada probably makes the most sense. You know, often investors, if you're raising money in Canada, they don't like investing in foreign incorporated jurisdictions. So, you know, you might have financing issues if you decide to incorporate elsewhere. For things like government grants, in many cases, they're only available to Canadian companies. And then kind of much more complicated, but taxation and employment issues, it could end up being simple if you just simply incorporate here. You know, each province has their own corporate statutes, and there's actually a federal one, the CBCA as well. Either kind of makes sense. You know, if you're based in BC, you probably want to do a BC company, although that's not required. But generally speaking, BC is also quite user friendly for corporations. So, you know, essentially, if there's not a good reason not to incorporate in Canada, it probably makes sense to do it. You know, if there's a certain investor who demands that you're, you know, a Delaware company, then you might have to. In terms of general structuring, really, when you're starting off, the simpler the better. So, you know, you want to keep, maybe a general structure would be just unlimited number of common shares, unlimited number of blank check prefs. The blank check prefs are, you know, essentially a class of shares that you can later on bolt on a bunch of special rights and restrictions if you need to, in various series. But essentially, you want a simple structure because as you add, you know, as you add various rights and restrictions, it just adds layers of complication. And then financing, you know, you'll have to look at if you want to take on debt or just do it through equity. You'll have to look at the various rights and restrictions that you give shareholders, you know, terms of a shareholders agreement, that type of thing. And then for things to avoid, like we're saying there, you know, secured debt, one thing to be careful with secured debt is, you know, you can really only have one person as the main secured lender. And from that point forward, you know, that person can kind of dictate how your future layers of secured debt. And then using multiple share classes, like we said, really the thing to avoid there is just adding too much complication, because as you have layers of investors, they'll be looking at your share rights and wanting their own their own additions. So if you can hold off on multiple share classes as long as possible, that's always ideal. And then incorporating offshore, we kind of talked about that already.
Tax considerations, yeah, so there's the tax considerations for financing really depends on the form of the financing, so what it is, obviously, so equity, for example, there's sort of a couple ways you can kind of deliver the equity to the investor. So for example, a founder could sell their existing shares. More commonly, I would say, is the company issues new treasury shares, then the money actually comes into the company. As Sam mentioned, multiple classes of shares. Do you want multiple classes of shares? Sometimes investor will want a new sort of separate class of shares. If you go debt, one sort of just key concept to keep in mind is where you have a non-resident lender. Canada has what are called sort of thin capitalization rules. So basically, they restrict the amount of debt that the company can take on and deduct interest on that debt. So there's basically a 60-40 debt to equity ratio. And the idea with that is that if you didn't have that, you'd have you have a company operating in Canada, carrying on business in Canada, but all of its profits are basically going to pay interest to the non-resident lender. So all of a sudden there's no income in Canada, and the idea is that it's eroding the tax base by interest expense. So that's an important one where you have a non-resident lender. Other than finance, probably one of the more important pieces, I think, is this. We talked about it briefly before. This notion of a CCPC and creating and then maintaining CCPC status. And so I'll talk about what that means in a bit. But the general point is that as a CCPC, there's all sorts of tax incentives. So for example, CCPs are eligible for the small business tax rate. So to give you a sense, that's 11% instead of 27%, up to the first 500,000 of income. So a significant difference. There's the lifetime capital gains exemption. So what that means is on a sale of by the shareholder on sale of shares of the company, they're basically eligible for this lifetime capital gains exemption. So basically, they could sell the shares, realize a capital gain, and pay no tax on it. The actual amount it's adjusted for inflation, so it increases basically every year, but it's about $900,000. So it's a significant tax benefit for investors. So that's an important one. As a CCPC, they also qualify for enhanced SHRED benefits. SHRED stands for Scientific Research and Experimental Development. So for tech companies, this is sort of a critical tax benefit. I think it's Canada's largest sort of tax expenditure, this SHRED program. So it's massive and it's really significant benefits. So non-CCPs are also qualified, but they get basically worse treatment than a CCPC. So for example, a CCPC gets a 35% tax credit instead of 20% tax credit. But maybe most significantly, they also get a refundable tax credit. So what that means is if you basically how the program works is you spend $100, for example, on qualifying expenditures. So think salary paid to a researcher carrying out scientific research and development. The company gets a $100 deduction for that $100, but they also get a $35 tax credit for that $100 of salary that are paid. And because it's refundable, that means even though the company has no tax at this point, it actually gets cash refunded, paid to them by the government in the form of a tax refund. So that's quite important, especially when again cash is scarce. And then also talked about before, stock options. They also get slightly better treatment for CCPCs. All of which is to say, CCPC status important, good thing. Really, what is it? What does it actually mean? So there's a few conditions. So basically, the corporation first of all has to be incorporated in Canada. So we talked about before, sort of, do you incorporate offshore? And I certainly echo what Sam says. If there's not a good reason to, there's certainly no good Canadian tax reason to incorporate outside of Canada. Generally, maybe there are sometimes, but generally not. The company has to actually be resident in Canada for tax purposes. if it's incorporated in Canada, it's deemed to be resident in Canada, so that part's fine. But the key piece here is public corporations and non-residents in aggregate can't hold more than 50% of the voting shares of the company. So basically and it's not just sort of one public company or one non-resident, it's just in aggregate. So in general, you want to just limit the number of shares that are owned ultimately by these types of entities. There's also a notion of how public companies or non-residents can't have de facto control over the company. So there's basically de jure control and de facto control. De jure means legal control, so that's basically you own more than 50% of the votes. Then there's a much more nebulous, difficult to define concept of de facto control. So this means, okay, I don't actually have legal control, but I have a high degree of influence in basically any way you can imagine that might involve, could potentially be de facto control. For example, you have a single Canadian resident shareholder, but there's a non-resident basically for whatever reason, based on a relationship or something, is telling this person how to act. That could be de facto control. And okay, founder shares.
Yeah, so just a couple of things on founder shares. So this is kind of your initial share capital or cap table among the founders of the company. You'll kind of decide amongst yourselves usually how you want to allocate the initial ownership. Often you'll issue shares to yourselves at some nominal value. You might each pay $1 to get 1 million shares each. And the idea here is, you're kind of working for the equity in the company. Usually these are just plain vanilla common shares. A couple of things to keep in mind is that you want to issue enough shares, and so we kind of arbitrarily pick like 5 million in aggregate or 10 million in aggregate. It just makes it a lot easier to manage down the road when you're worth $10 million and it's $1 per share, rather than having 3 shares each and then each of your shares are worth $150,000. It just gets pretty cumbersome. Often you want to consider vesting, particularly if there's more than one founder, usually having a vesting schedule attached to these shares, and it's actually technically a reverse vesting, so that the shares can be clawed back if they're not fully vested. Usually recommend getting this set up right at the outset, just to manage expectations with everybody. If somebody decides this really isn't their passion anymore and they want to leave, you've already pre-agreed what that looks like for their equity. And then just, making sure you're issuing them to the right people. I've seen circumstances in which, a founder is kind of like the operator, and maybe their friend had a good idea and issued them a bunch of founder shares, but they're not really involved in the business. That's often not a great relationship. So just being careful about who you're issuing your founder shares to, and mindful about it for the future. And then I'll talk a little bit about sort of after you've set up your initial cap table with your founders, then maybe you're out looking for funding. So just a few things to go over in the topic of financing generally. This could be a whole kind of other 2-hour session, but just at a high level, this comes in the form of non-dilutive, grants, R&D credits, government programs, things like that. And then there's also obviously debt financing, which is non-dilutive, and that's secured bank debt financing, or it could be unsecured loans. As I mentioned, your founder shares are often pay anything for them or next to nothing for them, and then the founders might cover expenses of the company in the early days, and those are usually loans, just on your balance sheet as a shareholder loan. Or
besides the finder, how about the co-finder?
Pardon?
Co-finder. Co-founder reason.
I didn't hear the question.
Besides the founders, there's another called the co-CO, co-finders. Co-founder.
I heard the word co-founder. I didn't hear the rest of it.
So they assisted the founder to set up a company or working for a long time.
The finder?
Co-founder.
No, just I mean, there can be more than one founder. There can be multiple founders who get founder shares. It's not just one single person.
Yeah.
It's just your kind of initial team. Oftentimes they'll get a bunch of founder shares.
Sorry, thank you.
And then probably the more meaty topic is around dilutive sources of funding. So this is usually equity, and it can be in kind of two broad categories. It's either priced equity, which would be shares, or convertible instruments like convertible notes or safes. And the difference is really, have you agreed on a valuation for the company or not? I'll go through a little bit on kind of what the sources of capital are, and this is somewhat chronological. So initially, got founders and friends and family. These are kind of really early days people writing generally smaller checks, and it's kind of a belief in either the idea or the founder. There's not much, this is pre-MVP, this is pre-revenue, this is early days, and they're making kind of usually smaller investments on the basis of a relationship with one or more of the founders. Then there's angel investors. These are kind of high net worth individuals in the community. Maybe they're successful entrepreneurs. They've had an exit. They're looking to kind of make investments or just otherwise interested in one or more areas in which you're operating. A little bit more high risk. Usually they can come in as early as the friends and family are as well. But again, it's usually based on a relationship and an investment in the sort of founder group or idea, as opposed to there being sort of a lot of existing traction already. And again, usually at this stage, the valuation is still pretty speculative. And then you get into kind of the institutional professional investors, seed funds, VC investors, professionally managed, usually managing sort of funds from large limited partners. They more heavily negotiate the terms of their investment. Again, this can be a lot. Sam talked about this a little bit, kind of the terms that an investor in this category would typically expect. We're doing a lot more due diligence on the company and its operations and what's in that toolbox, less just like a relationship of trust with the founder team. And then strategic investors are in a similar category. They're just kind of often investing for a different purpose. It's not necessarily just purely returns driven. It could be kind of a strategic reason why they make an investment into a company that's maybe in the same area but doing things a little bit differently and want to kind of maybe get access to it or as a potential acquisition down the road. Often they're kind of a customer relationship as well. And then this is kind of, again, the chronology for an equity financing. Early days pre-seed, it's funded by founders, friends and family, angels, often non-priced, one of those non-priced instruments I mentioned for convertible note or safe, or it could just be plain vanilla common shares. We see that relatively often for an angel investment. And then you get into seed. This might involve kind of micro VCs, early stage VCs. Again, often this could be convertible instruments or a light preferred share, like a simplified preferred right that the investor gives them. Usually it has some downside protection, but not a lot of control over other aspects of the business. And then you get into your Series A, B, C, and beyond, usually led by your typical venture capital fund or maybe private equity and a growth equity investment, or could be a strategic investor. The market for this is kind of more well developed. It's preferred shares with all kinds of rights attached to it that give investors economic protection as well as kind of some control over key business decisions. I'll walk through briefly kind of like what is a safe and what is a convertible note, because that's usually most relevant in the early days. You might all be familiar with this already. So this safe, it's a simple agreement for future equity. It defers the valuation of the company. So someone's making an investment and they're there we go. You might agree on like a cap to the valuation, but you're not agreeing on what actually the valuation of the company is today. But they want to invest a certain amount, and they'll kind of defer that decision to later when you maybe have a VC come in and negotiate an actual valuation with you. So as I mentioned, the kind of key parts of this are, what is the valuation cap, if there is one, and is there a discount to the next round as well? And then usually they get, when that next financing round happens, the holder of the safe gets the better of the two. It's not debt because it's not repayable. You're also not a shareholder until the safe actually converts. There's usually not a specified timeline. It's just whenever that next equity financing happens. And unlike debt, there'd be no interest rate or maturity date, like you would have with a convertible note. So convertible note and safe are usually very similar in that it's that you're deferring that valuation discussion. Often we'll have either a valuation cap or a discount rate or both. The key difference being that it is debt. So in someday, if you don't do that financing that converts the note into equity, it becomes repayable. Often there's interest rate attached to it as well, so the amount of it grows over time. And then it can be secured against the company's assets, so it's kind of a first ranking charge. If there's, you don't do that equity financing, you reach the maturity date, it has to be repaid. They have a first claim against the assets of the business. See that more commonly later stage, early days. It's often unsecured. The value of the security really isn't there quite yet. So that's kind of a brief. Again, we could spend a lot more time talking about this, but that gives you an idea of the landscape for that. And the last thing I want to mention on this financing related topic is the venture capital to the EBC program, which you may or may not be familiar with. If you're not familiar with it, read up on it. Like, that's kind of the best thing I can tell you is there's a lot of different categories of companies that are eligible to apply as an eligible business corporation. If you're looking to raise money from local investors in BC, all of them will ask you if you're registered as an EBC. There's no harm in looking into finding out whether or not you are. And the main benefit is, well, there's a downside in that you have to register and you have to do filings annually, and there's a cost and time associated with it, but the investor gets a 30% tax credit on their investment, which is hugely valuable, and a lot of investors will only invest if they can get the tax credit, or it will materially change kind of your valuation and pricing discussions with them. And there's certain budgets for it too, and they run out, so get it done early. We often are scrambling in the fall to get some investments done before the budget runs out.
Okay, so I spoke earlier about how there are limits on how you can go out and sell these type of securities, and really that comes from Canadian securities laws. There's often a bit of confusion on what to whom securities laws apply to. It's not just public companies or those companies that are listed on a stock exchange, but the general rule is all companies who issue shares or any sort of these convertible debt, safes, any of that type of stuff, they would be subject to securities laws, and that's really the limits we were talking about before. So this next section really talks about who can you sell at a high level, who can you sell shares to. You'll want more specific legal advice when you're actually in the process of doing a financing. And also keep in mind that securities laws really are local, so it'll depend on what province you're looking for investors, or if you're looking offshore as well. So you're gonna need advice from various jurisdictions probably. So just starting from the very beginning, the rule is if you're selling a security, which again would include shares, it would include convertible debt, it includes safes. The general requirement is you need to give the investor a prospectus, and a prospectus is this complicated long document that tells everything there is about a company. And typically filing this prospectus is how you become a public company. Obviously most private companies aren't doing this, so how do they raise money? Essentially you need an exemption from that requirement, and that's really kind of what we're going to talk about, because that's how generally speaking companies are raising money on the private end. So this next slide is kind of the list of not full, but these are the standard exemptions that people are going to rely on to do their private placements. You're going to need specific legal documents. So again, you're going to want to get legal advice. You're going to want specific reps and warranties from your investors. There might be specific forms you actually need to file or you need to get in order to rely on these exemptions. So just keep in mind this is a very high level discussion, and we would suggest getting legal advice before you kind of get into this. So just starting with the first one is friends and family. As Geoff mentioned, the first money that's coming into your company is probably through friends, close family, close business associates. So under this exemption, you can essentially sell to individuals who have a certain connection to a director, officer, or founder. The idea is that, if you're close enough and you know them well enough that they won't, that you can go get information about this company. You don't need this, all the general whatever. You're just relying on the relationship. So this includes family members of directors, senior officers, control persons. This will include close friends and family, close business associates. And keep in mind, it has to be like a close friend or a close business associate. It can't just be kind of a connection off LinkedIn or, someone briefly. Right. It has to be, a close friend and family. Typically, a non-legal test we use is, do you know how many bathrooms are in this person's house? Someone well. The regulators, they have like algorithms that search through documents. They don't believe that someone can have 50 close friends. They're going to expect it to be kind of the 10 and 15, and if you're going over that, they might knock on your door and ask questions. With that being said, there's no limit on how many purchasers you can use to rely on this. So something like family, it's easy to delineate. It's brother, sister. So this can be relied on quite a bit. And I think I went through this one already. So yeah, just make sure you're not calling everyone a close personal friend and then trying to rely on that, or a close business associate. And that's where the trick is for this. The next one is accredited investor exemption. This generally would be high net worth individuals, and with the idea being that they can basically take on the loss, and hopefully they're more sophisticated investors that can know how to evaluate the risks of these type of transactions. And again, accredited investors would include financial institutions, pension funds, things like that, but more so for our purposes, they would be individuals with over $1 million in financial assets, individuals with net income over that exceeds 200,000, individuals with 5 million net assets. And there's very specific definitions, so you're going to want to look at it closely. Again, and another thing to watch out here is that you can't just necessarily believe anyone who walks off the street that says, I'm an accredited investor. There are some requirements to do, some sort of background checking, so that you can rely on their representations. Private issuer exemption. This is an exemption that you can use when you're still quite tightly held. I spoke earlier about that 50 shareholder limit. This is where that comes in. How you calculate that 50, you're going to have, there's specific ways to how to calculate it, but essentially, if you're under 50 shareholders, you can kind of raise money from the same type of individuals I just talked about, close friends and family, directors, officers, accredited investors, and things like that. But the benefit is if you can still be considered a quote unquote private issuer, there's kind of less obligations on you when you're raising those funds. So what is a private issuer? It's someone with less than 50 shareholders, although again, that how you count that is a bit tricky. So you'll want to go talk to a lawyer to figure that out. The other is that you're going to have restrictions in your articles and things like that. The other thing to keep in mind is that once you lose your private issuer status, you can't gain it back. So once you kind of cross into and you get into 75 shareholders and you kind of reduce it, it doesn't matter. You've already lost it. Once you lose your private issuer status, keep in mind, it doesn't mean that you're a public company now. It just means you can't rely on this specific exemption. You can still rely on the other friends and family one we talked about, the accredited investor one you talked about. It just kind of means that there's a few more regulatory requirements, including some filings you need to do. But that's kind of the 50 shareholder threshold we're talking about. From there, those are the kind of the main ones you rely on. There's other ones like this employee, director, officer, consultant exemption. typically this is the one you're going to be using to issue stock options, for example. And again, even issuance of stock options where you're not actually getting cash in the door, still need a prospectus exemption. Securities laws still apply because that is security. But you know, there is an exemption like this one. And then I guess
So just, and I'll just give you a quick overview of some of the legal agreements you might encounter, particularly in the early days and in the context of raising capital. NDAs, again, you see this in the commercial context as well, with potential customers or even suppliers. It sort of is a contract under which, you know, one party or both parties are obligated to maintain the confidentiality of the information they receive, which is pretty critical in the early days where, you know, maybe you have some patentable technology that you haven't applied for a patent for, or, you know, your value is a lot in the, you know, trade secrets. So having a contract in place is pretty key. In the capital raising context, often I think you'll find that investors don't like to sign NDAs. You'll get, you know, often an aversion to that, particularly professional investors, VC funds. They often have policies that they never sign an NDA. So kind of the reputational risk and trust in that context, or you know, limit the amount that you will disclose in that context. So keep that in mind. You don't always sign an NDA with anyone that may be thinking about investing or does invest. But you know, it doesn't hurt to ask. Term sheets, these are kind of the first stage in any financing. It sets out the high level terms of what that financing is going to look like. Is it going to be shares? Is it going to be a note or a safe? Often you skip this step when you're doing a convertible security like a safe, but it can be helpful to get aligned with an investor as to what exactly you're offering, what kind of rights they're going to get, what they're going to invest, and how what the company's worth, things like that. So later stages, as part of your Series A, the term sheet's quite comprehensive, number of different pages and really detailed. And the benefit of it is really, you know, doing a lot of the legwork up front to align with your investor or group of investors as to what the terms of that transaction are going to be, so that you're not wasting a ton of time when the lawyers are involved, passing tons and tons of drafts back and forth when key terms are changing over and over again. It becomes quite inefficient. So the more you can negotiate up front, the smoother that subsequent process of actually closing the financing will be. And then the subscription agreement, that's kind of like a share purchase agreement, investment agreement, whatever you want to call it. It's could be the safe or the convertible note itself. These are actually kind of a definitive document under which the investor will make their investment. The company makes representations and warranties about its business and cap table, that if they're wrong, the investor could make a claim for damages and loss. They made their investment on the basis of these things being true, and if they're not, they have a claim. So that's kind of the key feature of that, and it sets out again the actual terms under which they're making their investment. So that's a quick overview of what those legal agreements in that context look like. I might pause there. I have a couple of slides on stock options and cap table evolution, I suppose, but now would probably be a good time to do questions, and if there aren't any, I can jump back to this before we wrap up. I see hands. All right.
So the reality.
Oh, sorry, Angie. I will do that. Yes.
Questions on
Oh, great. Okay.
So the reality is, we are a startup. As a startup, we're not cash rich, so we can't pay employees. So we have to take on. I've termed them now as contractors because my accountant told me I couldn't call them employees because they're not being paid. They're a contractor. So one of the challenges is that we can't pay them, so we're issuing them shares or stocks. I don't know the proper word for this. And I just try to figure out, you know, how's this done and what are the tax considerations when you look at all this, because there's so much that plays into it. And you know, they're looking after me, and so I want to look after them.
There's none of us here are employment lawyers, unfortunately, but see this all the time. There's an element of employment law relevant where, you know, I think as Chris mentioned, you could call somebody a consultant, but they're really an employee. And so, you know, for legal purposes, they could claim that, you know, they should have been compensated as an employee. They're entitled to common law notice and severance or pay in lieu of notice whenever they're terminated. And, you're supposed to withhold and remit to CRA and their, call up CPP and EI, all of that stuff. And that's just based on whether they are in fact an employee, even if you called them a consultant. So it's a risk you bear if you hire someone as a consultant because you can't afford to pay them as an employee. As an employee, you have to pay them at least cash minimum wage. There's
We
no
can't,
way around that.
we'd have to
So,
close down and be shut down. We couldn't operate as a business.
yeah,
To
those-
operate as a business, we have to be creative in our approach.
Yeah.
And that's our creative approach. My accountant tells me, I talked to my lawyer says he's not a tax accountant, he can't advise, I gotta hire a tax accountant. But he says, you gotta ask your accountant those questions. My accountants advised, they're not employees, they're contractors. Don't call them employees, call them contractors.
yeah, so you just hope that you can justify that they are a contractor and you bear the risk. That's
And
all you can
again,
do.
they're also globally located, so some of them are in USA,
Mhm.
some of them are in Singapore, some of them are in UK.
Yeah, so it'll vary
Some
by
of them
like
are
the
different.
laws of each, like the laws of the jurisdiction in which you're engaging them would be relevant in that case.
We're gonna alternate online,
Yeah, okay.
online, offline.
And already I didn't repeat the question, I'm sorry.
Okay, well, it's close enough for them.
Okay.
That's why I'm standing
Yeah.
here. Okay, so this is, I think, a question from the tax side. If you federally incorporate as a for-profit business, are you automatically a CCPC?
Should I repeat the?
No.
Okay. No, but you would meet, one of the conditions, two of the conditions, actually. So to be a CCPC, you need to, the first condition, or the first two conditions, you need to be incorporated in Canada and resident in Canada for tax purposes. So if you incorporate federally, you're incorporated in Canada and you're deemed to be resident in Canada. So you meet those conditions, but the other conditions you have to meet relate to ownership of the company, so shares. So as long as public companies, non-residents don't either have de facto control over the company or own in total more than 50% the voting shares of the company, you would be a CCPC. But simply federally incorporating is not.
So if you're provincial,
Same thing,
Same.
same thing, same.
Okay, I think you, the black shirt, sorry, go. That's you.
If, can a shareholder transfer the ownership to a holdco with and if the balance sheet is cash positive without triggering taxes?
Yeah, can a shareholder, so that you personally hold shares in the company,
yeah.
you want to transfer it to your holding company.
Yes, if I want to change the structure to a holding company and my balance sheet is right now cash, can I do that without triggering tax?
Yeah, and so the question is, can you do it without triggering taxes? I mean, this may be a question for Chris. I don't know what the balance sheet of the company would have to do with
I mean,
that.
Basically,
Yeah,
I
it's like the
cash,
accounting,
I don't feel like it's.
Yeah, so, I mean, you can correct me if I'm wrong. So you can, but there's like elections you have to file. It's like a rollover election so that you don't pay tax when you sell. You're basically selling the shares that you own to your holding company who's buying them from you and issuing you shares of itself.
There's
Usually.
probably a way to do it, but.
So
you
yes,
have to
usually,
do it
but
right.
other conditions have to be met, and there's usually a file.
Yeah, like if you just, like when you incorporate, you issue yourself a bunch of shares, you haven't contributed, you have no basically cost base in the shares, and then all of a sudden the company is worth something. There's value, I take it, in the shares. So if you do nothing and you just sell them to the holding company, you would trigger a gain at that time, which would be taxable. But as Geoff mentioned, there's a special election you can file. It's called a Section 85 election, which basically allows you to elect at your tax costs. And so basically, it's called a rollover because you basically defer the tax. And so you transfer the shares, you take back shares of your holding company with the same low cost base. And so basically the gain is, the tax on the gain is deferred until later. So yeah, you can.
Okay, another online question, and we'll go to you next. And just as a caveat for all of you, if you find the question is a little too particular for a broad audience, feel free to defer. Okay, so how would taxes affect us if we reissue shares purchased by the Treasury from ex-co-founder?
Yeah, generally those are like two different steps.
Okay.
So buying shares back from a founder that's a tax event usually for them. If it's done under a reverse vesting agreement that's structured properly, usually there's no tax. They buy the shares for a penny, you buy them back for a penny. It's kind of an even swap. Then you can separately issue new shares to a founder. Again, that's a whole separate transaction and could have its own sort of tax implication to it. As Chris mentioned, you know, if you're issuing shares to somebody, it's an employee. Founder's usually an employee. These rules that he went through would apply as to whether you pay tax right away or not.
But,
Well, and we do like can't afford their pre-revenue and we want to like hire a lot of people and just issue them some shares. Like a designer, graphic designer, marketing, and it's gonna be a lot of people working with shares. Are there any kind of risks?
Yeah, so you can hire somebody as a contractor and not pay them cash and only compensate them however you want. You could pay them $0 an hour and they agree to that and they do the work and great. The risk is they may not actually be an independent contractor. They may in fact be an employee at law. So the risk may often is that they later say you terminate their contract, say this isn't working out. They say, hey, you know, I'm not happy about that. Actually, I think I was an employee and I'm going to sue you for the, you know, at least minimum wage you were supposed to pay me and all these other things. And I'll complain to the Employment Standards Branch. And that's usually the risk.
But if they signed a contract, contract, then they wouldn't be able to come.
They could still very much claim that that contract said they were a contractor, but that's not what they were at law. They were an employee.
And that's for a Canadian too. So I mean,
Yeah.
it really end up depending on where your contractor /
But if they're not working a 40-hour work week, 20 hours a week or something.
that it helps. There's a bunch of factors.
You would just
there
argue that they're not an employee.
Yeah, I mean, but that's the risk. I mean, the other risk of paying people in shares obviously is that you just build up a huge shareholder base potentially. And obviously you're diluting, you know, keep in mind you can do a shareholders agreement or something like that. You know, what happens if that employee leaves under bad terms, you know, you might want something to be able to buy those shares back. So, you know, the other risk is just the general risk of having these shareholders and yeah, and so, I mean, there's ways to kind of deal with that and it's probably through a shareholders agreement, right? But yeah, that's the other like practical risk.
It is common to hire people as contractors. It is uncommon to see these claims that they're entitled to more than they are, but it can certainly happen and it does happen. It's not, I want people to think this happens every day. It's not that frequent, but very much a risk because it's, you know, the employment law is what it is.
okay, I think this is a quick one. Can you take on an additional co-founder at a later date? Is there a point where you can't take one?
Yeah, there's no legal restrictions around that at all. Bringing a co-founder much later, your options as to how you kind of bring them onto the cap table are certainly limited, but and usually limited by taxes often. But yeah, we do that all the time, and you can kind of just figure out what you want to do and work backwards with your lawyer and accountant to make sure you can get them some
The
equity.
benefit of bringing them in early, kind of the way Geoff described it, which is you bring in your founders and then your seed. At the time you bring in your initial founders, you're issuing shares for very, very cheap. But at the time, the company's not worth anything. There's nothing there,
Yeah.
right? So you can justify the valuation.
Easier to issue founder shares.
Yeah.
At a nominal amount when they're worth a nominal amount.
Yeah.
If you're issuing founder shares later at a nominal amount when they're worth a considerable amount,
That could be
you got to work
employment
around
income. That
the
could be a
tax
lot of stuff.
aspects of it. So.
Yeah, so my question is, for the competitive, for the non-competition part. Say, for example, you're a startup in the very beginning and then you hire someone who wears all hats and then they know the very critical infrastructure of your business. And then like you've mentioned, the court doesn't really like to reinforce this kind of things. So do you have to, as a business owner, do you have to be your own police to kind of, how do you protect your rights at the startup and when you grow and grow bigger and bigger for kind of things?
Yeah, I mean, like a contract with a non-compete in it is only worth how much time you spend to actually monitor it. Like if you have an early employee or senior level employee and you have a non-compete when they leave and it's enforceable, you gotta find out if they've breached it and keep an eye on it. So certainly there's an administrative aspect to it. And then if you do seek to enforce it, as Sam mentioned, there's a risk that it's not enforceable. Of course, courts generally kind of limit non-competes as narrowly as possible, so.
If you have someone who, is the company, is the face of the company, that's the instance where you potentially could, if you drafted it narrowly and et cetera, et cetera. But, yeah, it's still a risk. And then how you protect yourself. I mean, a lot of it, you can have non-solicit, you can have confidentiality agreements, but all these agreements are just kind of on paper. At some point, if you have to go to court to try to enforce something, I mean, it gets difficult, it gets expensive, right? So, I mean, there's almost like no practical, actually, yeah, it gets tough.
Sorry, we got 2 minutes. You got this.
I have 6 questions.
Go ahead.
How does that affect the share?
So you're talking about when you're transferring shares to your holding company and you're wondering about the share price? From the company's perspective, it doesn't really change anything. You've got 1 million shares outstanding held by you personally, and now they're held by you holding company instead. From the company's perspective, it just has a different shareholder. Doesn't usually impact the sort of value. I mean, value is very subjective in itself anyway.
Sorry, online, for CCPCs accepting investment from international investors VCs, is it more beneficial to get funding from US dollar fund?
Yeah, I mean, the CCPC thing is kind of as Chris mentioned, as soon as you get over that 50% threshold, whether they're in the US or somewhere else, it's certainly a risk that you lose your CCPC status. There's some fund tax structuring and planning that you can do to try to retain it, which we often help clients with, but whether they're in Europe or the US, it doesn't matter. Was that the question?
I think so.
Okay.
Yeah. Okay, so we only have a couple minutes left. Are you guys able to stay?
I can stick around for a little bit, yeah.
Should we go through this quickly? The cap table?
Just keep open questions.
We can continue questions. I think, this will be available on the slides if you want to look at it. It's kind of just an illustration of what your cap table looks like through different rounds to bring on investors and kind of how the valuation and percentages change, and it does.
Yeah, there's more, I can see there's.
But it's like-
So it's lower shares now.
So it's more, yeah.
Okay, so
Share dilutions.
it's 5:28. You have to leave at 5:30. You can leave. Otherwise, can we keep the Q&A going for maybe 10 more minutes?
Sure, yeah, I'll speak for you guys.
Yeah.
Yeah, we
Okay.
can do another 10 minutes, I think.
Okay, okay. At the back, I found this.
Lots.
You at the back, yes, go ahead.